Hey guys, Don Durrett, Gold Stock Data. I did a recent interview with Bill Powers, Mining Stock Education, and in that video, I mentioned a checklist and how to get an edge when you pick stocks. I thought I better create a video, a YouTube video. I mean, it's in that interview, but I think more people will see it if I create it here. So if you go on the forum, click on forum, and you go to good resources. There's a checklist right here. And these checklist is how I pick my stocks. So I've created this over the years. It's gotten improved. So for producers, we have 10, I guess the checklist has 10 items. So the first one is properties. And you want a quality property. So one of the things you're looking for is the size of the deposit. I don't have that here, but I probably should have that. But the grade's always important. You're going to be looking to make sure it's economic. The recovery rates, the mine life. So the mine life is kind of the size of the mine. The economics, the NPV, the CapEx, ASIC, the IRR. So you're looking at the properties and you're trying to find something that you like. You're trying to avoid, you learn, if a property, I mean, this is kind of the starting point. For me, for instance, for producers, I want I want a long life mine. So mine life, I don't want like 1 million ounces of gold or less, because if that's the case, you're looking at a less than a 10-year mine life. And once it gets below 5 years, if that's their only property, the stock's going to crash. It's kind of for me, it's kind of a cutoff 6, 7, 8 years, somewhere in there. You're okay, but once you get down 5, 4, 3, you're starting to have problems. And let's say a company has two mines, they're both say 50,000 ounce mines, and they're it's basically a 100,000 ounce producer, and they have two 50,000 ounce mines. If one of them goes bye-bye, they're going to lose half their production. They'll go from 100 to 50, or if they only have one at 50 and it goes bye-bye, they go to zero. So my life's important. All these are very important. So you're just looking for red flags. Next one is the location. So taxes and royalties are always going to be more issues in third world countries that are more likely to increase them. I think we're a little bit more comfortable or confident in countries like the US, Canada, and Australia. They're not more as likely to have significant increases in taxes and royalties, whereas African nations, South American, Central American, we can see tax increases annually sometimes. So that can be a issue. Permitting can always be an issue. We're always looking for potential problems. Um, you know, could they possibly lose their permits? Are they going to renew them? Are there permitting issues? Is their next mine going to be is it in a mining district? You know, if it is a mining district, it's easier to permit than if it is not. And the political issues, I mentioned that earlier, political issues and taxes and royalties kind of go together, and the infrastructure challenge. Bottom line, you kind of want one that's in a good country, in a district. Financing issues, this really comes down to their balance sheet. If they have a bad balance sheet, they're going to have trouble, getting more money or to build a mine. So this is going coincides with the balance sheet, but financing issues is sometimes it can be the size of the market cap. They have a small market cap. They're not going to be able to raise money. So any financing issues, management. This is all about experience, execution, past performance. Um, that's kind of an overview. One thing about management, the CEO, we want them to be able to communicate. It's really important. We want them to be able to market their company. So, and I want them to be a leader, but the CEO is the kind of the point man for the companies. They're kind of that's kind of your red flag. Valuation. Uh, we don't want to buy, pricey stock. We're looking for at least a three bagger, but for me, if I'm going to buy a three or a four bagger, I want it to have growth potential. Uh, Normally, I'm really looking for five baggers or better. So we're looking for cheap companies. When I say cheap, I mean they're undervalued. Avoiding expensive companies. And then we're looking for upside potential. And then the chart, we don't really want to chase anything. We don't want the chart to look really ugly. Really ugly chart would be a stock that just really is ripped and we're just chasing it. We don't want that. We always want a good chart. A good chart is a chart that hasn't broken out yet. Balance sheet. Ideally, we want a lot of cash and no debt. That's the ideal, right? We want them to have the ability to raise money if they need it. We don't want the market, if they need to raise like 5% of their share price, we don't want the stock to go down 5%. So we want them the ability to raise money if they need to. Um, but ideally, we just don't want to have a lot of debt on the balance sheet and then low cash. So balance sheet is very important. Cost margins. Um, so we're looking for strong margins of at least 30%. Anything that's below 30%. So if you take the current price of gold, let's say it's at 3,000, so 30% would be 1,000. So that would be 33% actually, but we want 25 to 30% is kind of our target minimum. Below 25% and the margins, you're just not going to be generating a lot of free cash flow. Ideally, we want 50% margins, but we're kind of targeting at least 25 to 30, which is kind of a strong player, if you will. And then, once you go below 20%, at that point, it's hard to generate a lot of free cash flow. And these companies usually, their share prices are going to be driven by the cash flow. And cost and margins kind of go hand in hand. So high cost, high margins, I mean low margins, low cost, high margins. So when we're talking about cost, we're talking about the operating cost, the all-in cost, the break-even cost. And margins, we're just talking about the free cash flow margin, which is the amount of free cash flow versus the current spot price. So we want around 30% free cash flow if we can get it. The silver miners have had really terrible margins until recently because they've had the costs have went up through inflation, and so we've had ASICs around $22, break even around 27. So if silver's at $30, you have 10% margins. That doesn't get it done. We're current silver's finally up to 30% margins. Exploration pipeline, we want companies, we don't want a company to have, one property and then it doesn't have exploration potential. So it's basically kind of that's all they have, right? Let's say they have, 1 million ounces or less and they have no exploration potential. That's not a good situation. We want companies that have one, two, three properties. All of them have exploration. They have say three properties, one's in production, and the other two are potential mines. So we want that. We want companies to be growing, so we want potential sharks. So we want them to constantly be adding to their pipeline. When I say a shark, that means I want them to go gobble up some of these, other producers or other development plays, and grow their pipeline and grow their production. Share structure, share dilution. Um, so the structure is less important for a producer than it is for a developer exploration play, but we're looking at producers here. So the share structure, um, the important thing here, we don't really want it to be, uber diluted where, the share price is like under 50 cents and, they're a producer. Ideally, if it's a producer, we'd like to be, over $1. at least. So some of these companies have a lot of dilution in their producers, and they have a share price under 25 cents. You don't really want that per se. Ideally, I'd like to be over a dollar. If you're over a dollar, it makes it a little bit easier to raise money. You're not going to dilute quite as badly. Um, and then dilution. We don't want companies that are producers to be diluting shares. We want them to be growing organically. So we can look at the history, and if it's a producer and they're diluting, that's not good. It's basically a red flag. Then the overall risk, we're looking for good, very good, excellent. We're not looking for average or not so good. So we're looking for pretty strong risk rewards. So they check all these boxes and they don't have any significant red flags, then we're more apt and one of these is the upside, the valuation. We're more apt to buy it. So we're looking for one that doesn't have any problems. If you can identify that, then you have an edge, I believe. You basically have found a quality producer that's cheap, and that's what we want to do. When you find these, you buy them, you should be excited. It's like, oh wow, look what I found, kind of thing. Okay, the developer checklist. Um, a lot of my mistakes that I've made with developers is because they didn't check all of these boxes, and I've learned that they really need to check them all. And if they don't check them all, you need to be confident that they're going to kind of fill in the blank. The one that's usually missing is number five, the passive production. So you have to be confident they're going to be able to they're going to have to fill that one in. But usually everything else is kind of there. Like the strong project, we don't really have to review this. We did this with producers. It was the same thing. High upside potential. But the difference between the producer and the developer is because so much can go wrong with the developer, we want more upside. So at least a 10 bagger with a developer, at least a three bagger with a producer. Good location. Now this is developers, so they haven't built the mine yet, so it becomes even more important that the mine they're building is in a mining district or a mining friendly country. It 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 can take a lot longer to permit a mine that's not in a district. Um, and if we can get delays, sometimes you don't get the permit. So you got to be careful with the loc and developers. The location becomes even more important. Strong management team. This one is also very important. It seems like once a company is up and producing and they're doing a good job, then you kind of check the box on the management team. But with the development company, it hasn't built the mine yet, so we don't know. We don't know if they can build it. We don't know if they can operate it. A lot of things go wrong when they start ramping up production, and usually it has to do with experience. We've seen this over and over again where companies have failed because their management team wasn't strong enough. Happened to Pure Gold. It's happened to Ascot. Happened um, mine in Colorado, and I can't think of it. Happened to Alexco, Arcana. Happened to that's four companies. There's another one in Colombia that had a problem, had a ramp up problem. So ramp up problems occur, and so you got to be really careful. Making sure that the CEO has past experience and he has a good team around him and a good board. Very important. Path to production, again, I mentioned this is the one that's usually lacking somewhat. But if you can find a team, a real strong team that has a really good plan and has a good path and has it all lined up, that's kind of what I look for. And then the insiders, if they don't have at least 25%, you're really rolling the dice. I would say 9 out of 10 times a really strong project that's uber cheap, 10 bagger that doesn't have strong insiders usually always gets acquired either before first pour or right after first pour. I see it all the time. You got to have those strong insiders. So when they get those phone calls, they say no. They say, we're not for sale. Um, but if you have low insiders, for some reason they just always fold. They get the phone call and they say, "Oh, you want to pay 40% premium? Sure, we'll take it." Um, so you want developments that they pass all of them. Each one of these has an equal weighting. You got to have all of them. You want all six. Sometimes you can make it an exception for the passive production if you're confident they're going to get there. So I'm okay rolling the dice once in a while. If they have strong insiders and I get a feel for the management team. But if I don't, I'm gonna, not gonna get super excited about it. Um, there isn't one caveat with owning a developer that you're not really super confident they're going to build the mine. And that is you just want to own the project and you don't care who buys it. An example of that would be like Abra Silver. I like the project. Any of these development projects, you really like them. Like I'm going to own Vizsla, I'm going to own Go Gold, I'm going to own Discovery, but I don't think those are going to get taken out. But Abra, I think probably will. But I want to own that project, so I'm going to buy it. If they get taken out, fine. I'm just going to cross my fingers it isn't a major or it isn't become, a Chinese company taken out for cash. So if you just want to own it, then that's another reason, because whoever acquires it's going to make a lot of money. So it's going to be very accretive for whoever buys it. The last one, okay, these are exploration stocks. So one thing I learned when I first started doing this is that it's very difficult to find economic large mines. And those are really the only ones where you make, five baggers on exploration plays. And there's usually one, two, or three of them a year, and that's it. And so, I was betting on project generators that didn't have a discovery, and they would do nothing. They would languish. So that was the lesson I learned. And I was like, how come? I thought this project generator model was good. They have a good team. Seems like a good property. Seems like a lot of good drill targets, but yet they didn't find a big mine. If you don't find a big mine, it's just not going to work. So what I found was over time was I only found two things that seemed to work for exploration companies where you kind of have an edge. Again, if you follow these two lists, this list for producers, this list for developers, I think you're going to have an edge. And then my two rules for exploration plays, I think if you follow both of these, you're going to have an edge in those as well. So the first one is optionality. So with optionality plays, you just want to find companies that have big deposits in good locations that are very, very cheap. So you want to buy like gold in the ground for under $20. Around 10 is good, but under 20. Because if they could sell it for 100, then you got a four bagger there. And if they find more gold, so maybe it's a four bagger today, and they find more, then could be a five plus bagger. And then maybe they pivot to development and it's a 20 bagger. So I like optionality plays. It's like for me, it's like you're just going to get paid. You just, it's almost like stealing money. It's like, it's just easy money. For example, I mean, Free Gold Ventures, when you buy Free Gold Ventures, it was down, I think $8 an ounce at one time. Now it's up to 15. But when you buy it right now, for instance, Free Gold's at $15 an ounce in the ground, they're finding more even, but they're not going to sell it for $15 an ounce in the ground, and the mine will get built. So it's just a matter of how much money you're going to make. Are you going to make 100%, 200%, 300%? I think we could make 400% plus, and if they do a 50-50 JV, it could be a 10 bagger plus. So those are the kind of companies, those optionality plays, where you can just buy gold in the ground very cheap, and you just sit there and wait and get paid. There is a bit of opportunity cost if they sell early. Sometimes I worry about companies that sell early. What I mean by sell early is they can just give their project away for like a 50% premium. And instead of getting a one, two, three, four, five bagger, you get a 50% return. That's not good. So the optionality play is rule number one. Rule number two is the Lassonde curve. And so if you don't know what the Lassonde curve is, do a little research on it. But basically, it's the curve of the share price, how the share price goes up. So if you're an exploration company, you have a market cap, say, of $5 million, and you just IPO'd, your company's done nothing. The share is basically at the very bottom of the chart, and then when it starts going up, that it makes a discovery and it goes up, 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 up. That's the Lassonde curve, basically making that first initial move. And what it does is it peaks out after the basically the discovery's been drilled out. That's phase one of the Lassonde curve. And then after it's been phased out, then it goes into development and it goes down. Because when you go into development, all you do is spend money to get it developed. And then it goes all the way down. And then after it gets built, then it starts going back up again. But we're for exploration plays, what we're trying to do is get that initial surge. So we don't want to buy it at that initial surge. We want to buy it at the bottom. So you're buying early in the sun curve. So you could basically it's real easy. All you do have to look at their chart, and it shouldn't have moved yet. So you want to buy. You're only going to buy these exploration plays when they have market caps of somewhere between 5 million and 50 million. And it's basically just made a discovery and you're jumping on board of that discovery hole and then you're going to ride it and let them drill out the story. The thing that's beautiful about these early exploration plays is they're somewhat price inelastic, meaning that they don't care about the gold price or silver price. The only thing they care about is more ounces that are being discovered. So it's an early discovery and you're chasing the drill bit and you're just riding those discovery holes up and you're just riding the share price up until it gets drilled out. So it's an early discovery. And so basically it doesn't have a maiden resource. It's just the first significant drill hole. From that point forward, for the next 1, 2, 3, 4 years, all they're going to be doing is adding ounces. And as they add ounces, the value of the company is going to get more valued. And it's somewhat price inelastic. That's why people love these exploration plays because normally these gold silver plays are very price elastic, such as producers and development plays. But a developer can be price inelastic. Now, the key here for this Lassonde curve, buying early on the Lassonde curves, you don't jump in unless it is an excellent drill hole. And ideally, you want a stellar hole, but at least excellent. So you want the ground meter has to be at least 200 or you're not touching it. And at least 2,000 for silver, you're not touching it. And so you want to buy these. If you do that, and if you get in early, and basically what you see some a company, and there's only been like two or three of these a year, the company will come in with this beautiful drill hole, and it'll be early in the sun curve, so we'll have the market. It's going to be a flat chart, and have a market cap under 50 million. You jump on board, and then you wait and chase those drill results. Now the chances are they'll have a follow-up hole or a few, and it'll go higher. Now, if they don't, then they're going to dilute shares to do that second round of mining, second round of drilling, and it'll start down. So you could basically do a 20%, 25% stop loss would be your worst case, and then have a trailing stop on it. So once it went up 25%, you're not going to lose money. And then you're basically just hoping that it hits some more drill holes. But it's not a bad strategy. But those are the only two rules that if you follow those two rules, you're going to have basically an edge, I think. And then for these three checklists, the caveat is the gold silver price. The only way, except for these exploration plays, which are somewhat inelastic, but to really do well, ideally, even in explorations, but especially producers and developers, you want that silver. The silver price needs to go higher. So we're betting on the metal price. So we're basically speculating on higher metal prices. So that's how you get an edge. That's what I've learned. So we'll end it there. All right.